Good morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX Global, bringing you the morning comment for the 29th of February. G20 meeting. More concerns, but no action. The meeting of G20 policymakers ended with no new coordinated action to spur global growth. Even though the members seemed to be more worried this time about the prospects for global economic growth and showed growing awareness of the need for financial stability, they simply reiterated past policy commitments. They agreed to use monetary, fiscal, and structural tools to boost growth, underscoring concerns over the limitations of central bank-led stimulus measures. With regards to the exchange rates, the G20 reaffirmed that they will refrain from competitive devaluation and that they will not target an exchange rate for competitive purposes. Officials also added potential Brexit and the large and increasing number of refugees in some regions to its long list of concerns. Notably absent from the list were worries of China's slowdown, which as a host nation seems to have succeeded in being left out from the key risks in the final communique. Given that the group failed to take new bold steps to revive the global economy, we expect the markets to continue their pre-meeting trends and keep demand for safe haven assets intact. Now for today's events. During the European day, Eurozone's preliminary CPI for February is expected to have slowed from the previous month. The German preliminary CPI rate for the same month unexpectedly fell into the negative territory, which increases the probability that the bloc's figure may decline significantly as well. What is more, ECB's preferred measure of inflation expectations, the 5-year inflation swap rate, hit an all-time low of 1.38% last week. Given that bank officials have already showed their intention to reconsider policy at the March meeting, as the global turmoil threatens to impact Eurozone, this evidence increases the likelihood for the ECB to introduce another stimulus package in March. We believe that this could keep euro under pressure going into the meeting. In the US, the Chicago PMI for February is forecast to have declined, but to still remain safely above the 50 line. The indicator is highly correlated with the ISM manufacturing index, due to be released on Tuesday. Therefore, a decline in the Chicago PMI is likely to increase the possibilities for a lower ISM index, which is expected to remain below 50. The Dallas Fed Manufacturing Activity Index for February and pending home sales for January are also due to be released. We have no speakers on today's agenda. As for the rest of the week, on Tuesday, the Reserve Bank of Australia will meet to decide on monetary policy. At the latest meeting, bank officials kept the key interest rate unchanged due to an improving labour market. They noted the risks around the global outlook and stated that they will closely monitor incoming data for signs on whether the financial turmoil has impacted Australia's domestic demand. Therefore, as the incoming data did not reflect any significant impact from the global volatility until now, we believe that it is not urgent for the bank to alter its policy stance at this meeting. From China, we get the official and final Caixin manufacturing PMIs for February, and expectations are for both indices to have declined further below the 50 line. The UK manufacturing PMI for February is forecast to decline from the previous month, but to still remain above its 50 line. In the US, the ISM manufacturing PMI is expected to have increased in February, but to remain below the crucial 50 level for the fourth consecutive month. The forecast is supported by the declines in both the Empire State and the Philadelphia Fed manufacturing indices for the same month. Although this could hurt the dollar at the release, we would treat any weakness as a corrective move of the greenback's recent recovery. On Wednesday, the main event will be the ADP employment report for February, 2 days ahead of the non-farm payrolls. The ADP figure is expected to show that the private sector gained slightly less jobs than in the previous month. However, the print is expected to stay close to the 200K point, something that could increase speculation for a similar NFP figure on Friday. On Thursday, no major indicators are coming out. Finally, on Friday, the highlight will be the US employment report for February. The forecast is for non-farm payrolls to increase from the previous month, the unemployment rate to have remained unchanged, while average hourly earnings are forecast to have slowed on a monthly basis. This is the last employment report that Fed officials will have to consider before the March policy meeting, where markets are almost convinced there will be no change in policy. Another solid employment report could bring forth some expectations for more than one rate hikes this year, which could add fuel to the dollar's recent strength. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX Global, wishing you solid trading.